Hi, thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We go over what's impacting mortgage rates on a daily basis, whether it might come from the economic calendar or a combination of that with the headline news, geopolitical. And then sometimes it gets really confusing out there when you see good news is now bad news as the market sentiment changes. And we try to get into providing explanations of what's on investors' minds and why the market is moving the way it is. So hopefully this will give you'll get something out of these videos. And a little bit about myself is I'm a loan officer. I work with a national lender, so we do loans in all 50 states. So if we could be of any service from refinancing or purchase, please reach out. We'd love to be able to earn your business. But more than that, we'd like to be a resource for you folks. So if you have any questions, please feel free to reach out. Um, we'll be more than happy to try to get the information that you're requesting. So without further ado, we'll start off with the economic calendar. I normally use this one, but this one is kind of light information. There's a lot more data that's not being reported on here. So I took a snapshot of another one that has a little bit more set and highlighted, so at least that way it stands out a little bit more. So today was a big day I've been talking about all week, and that was the PCE, or personal consumption expenditure. This is consumer inflation, and this carries a lot of weight because it is the Fed's favorite gauge for inflation. So we'll start off with the month over month one. We're going to kind of skip it down here a little bit. So previously it was at 0.2%, but it went up 0.6%. And let's see here. That's month over month for the month of May, so it went up 0.6%. Now the year over year remained unchanged, going at 6.3 to 6.3. Now, when you strip out food and energy, you get what they call the core PCE, and that's what the Fed will also call real inflation. Now, the previous month, back in April, it went up 0.3%. Forecast was supposed to be a slight uptick to 0.4%, and it came in at 0.3%. So same pace as prior. Now, its year over year went from 4.9% with a forecast of a slight dip of 4.8 down to 4.7. So this is obviously good news because that CPI report we saw a couple weeks ago showed the opposite, and this again this carries a little bit more weight, and it was going to be kind of a scary week this week. So that's why I kind of said be prepared for possibility, because the markets reacted extremely negative for both the stocks and bond market for that. So as we'll touch on, bond markets reacting fairly positive towards this. The reason being is that inflation erodes the value of the bond over time. So this is why it's the greatest enemy for bonds. So when we can see tame inflation, that helps bonds grow a little bit more. So let's go back here a little bit. We'll start off with the personal income percentage for the month of May. So April grew at 0.4%. Forecast is showing a 0.5% increase, and it came in expectations, which is good news because obviously we like to see people make more money. Now we got the counterpart where we got consumer spending for the month of May. So in April, people were out spending a lot at 0.9%. Forecast was supposed to be a slight downturn at 0.4%, and it was almost came to a screeching halt in May at 0.2%. Then let's go down. We got the weekly jobless claims we get every Thursday, and last week was 229,000. Forecast was come for 220,000. It came in a little bit hotter at 231,000. Now, last but not least, we got the Chicago PMI, which is the manufacturing within the Chicago region. Um, so previously, back in May, it was at 60.3. Forecast was calling for 58, and it dipped a lot more. We've been kind of seeing this trend of pretty much everywhere. We're seeing that obviously manufacturing is dropping off pretty quickly. We saw that in New York, we saw the Philadelphia, and now Chicago. So we're seeing a downtrend of manufacturing. And of course, a lot of this is going to be on investors' minds. They're looking at this data. They're looking at this consumer spending that people almost aren't spending. And why is that? Because, well, inflation. I mean, people don't have the discretionary funds to go out and entertainment or go out for fun or buy things that they would normally buy, only because they're spending most of the bulk of the money now on higher grocery bills, higher gas bills, and higher energy bills. So these are things that, of course, are making a very large impact on the economy, and so this is reaping the benefits of that, so to speak, if you want to say benefits. So here, stocks are down as a result. You know, the Fed is going to have a meeting here coming up in July. We're almost there. We got end of the quarter, but more, you know, basically a lot of investors think we're heading towards a recession if we're not already in one. Because if you looked at yesterday, GDP was a negative. It increased the negativity down 1.6% for the Q1. So we'll probably start seeing Q2 results pretty soon, at least initial ones. Also, they're not feeling too optimistic about profits and stuff because some of the consumer staple companies like Bed Bath & Beyond wasn't looking too good, and they're going to be getting those corporate earnings reports coming in next couple weeks for the second quarter. So this will be something that, of course, uh, won't. This is what's kind of creating the sentiment in the stock market, or both markets for that matter. So now it looks like we approached the 25-day moving average, which is good news, even though the 25-day moving average has come down a little bit from where we were prior, before that CPI report came out. So we're up 33 basis points now, as you can see here, which is good news. So that means we're actually getting an improvement in our mortgage rates here today. So that's good news here for you. And yields, we dipped below 3% mark. That's good news as well. So we're down just under 2.98 right now for the day. And last but not least, we'll touch on the average rates for conforming limits. These are based off, of course, yesterday's pricing. And so the 30-year is now at 5.9, and the 15-year is at 5.25%. So the spread between those obviously aren't too high right now. Those have been kind of shrinking a little bit. And again, these are just averages out there for conforming limits. They do have points built into it, so that's why you're not seeing 1/8 increments on those. And if you guys would like a rate quote, just please feel free to reach out. We're here to be more than happy to oblige and see what we can do for you folks. But anyways, if you guys, again, got questions about anything, we're here to help out. So please feel free to contact us. Thanks so much for watching. And if you guys like these videos, please help us out and smash that like button and share. We greatly appreciate it and help out our channel. You guys have a great rest of the day. We'll see you guys in tomorrow's video. Tomorrow will be actually a short day because the markets will be closing early for 4th of July weekend here, as we'll have obviously the markets will be closed on Monday for the most part. But again, tomorrow will probably be a kind of a quick one because the markets will be pretty much a half day type of thing tomorrow. Have a great rest of the day. Bye-bye.